Many professionals focus heavily on monthly income, salary, revenue, cash coming in, and that is understandable. Cash flow feels immediate. But cash flow and capital are not the same thing, and the difference between them matters more than many people realize. Up to this point in the series, we have focused on income, margin, allocation, expansion. Now we introduce a deeper distinction. Capital is not the same as cash flow. Cash flow is movement. Capital is structure. Cash flow enters and exits. Capital remains. Let us slow this down. If you earn £6,000 per month, that is cash flow. If you hold £100,000 in assets, that is capital. Cash flow supports lifestyle. Capital supports independence. Now pause for a moment. Write down your current monthly income. Then write down your current total capital. Not future salary. Not projected earnings. Current capital. Seeing those two numbers side by side matters. Many professionals focus almost entirely on cash flow because it feels urgent. Bills are monthly. Salary is monthly. Expenses are monthly. Capital can feel distant by comparison. But capital changes posture. Capital absorbs shocks. Capital creates optionality. Capital reduces urgency. Let us illustrate this simply. Imagine two individuals earning the same salary, £7,000 per month. One holds £15,000 in capital. The other holds £250,000. Who negotiates differently? Who tolerates career uncertainty differently? Who absorbs disruption differently? The person with capital. Because capital changes behavior, not only balance sheets. Behavior. Now let us define capital more clearly. Capital includes liquid reserves, productive investments, ownership stakes. It does not include future salary. Future salary is uncertain. Capital is present structure. Now ask yourself one quiet question. If your income paused for 6 months, would your capital generate support? Would it produce income? Would it preserve optionality? Or would it remain largely static? That distinction matters, because capital architecture is not simply about accumulating money. It is about building layered strength, not chasing returns. Layered strength. Some forms of capital absorb shock. Some generate growth. Some preserve flexibility. Intelligent structure balances them. In the next episode, we will examine the layers of capital, because not all capital behaves in the same way, and intelligent architecture requires understanding those differences.